everybody. Let's start at the very beginning with Chapter 1, and we're going to begin by talking about the accounting landscape. Those organizations that play a role in how we do accounting. Now we're going to start with the FASB. This is a private industry organization, the Financial Accounting Standards Board, and their most important role is to create the accounting rules, to codify, create the accounting rules that we use. Those rules are called Generally Accepted Accounting Principle, or otherwise known as GAAP. Now, the federal government plays an important role through the Securities and Exchange Commission, the SEC. They were set up to protect investors, and their main purpose is to regulate public companies. Now, public companies are companies whose shares of stock are sold on the public stock exchange. They require those companies to maintain financial statements that provide accurate information, and they also closely regulate the operation of the stock markets for the protection of investors. Then we have the public accounting industry. Now, this would include public accounting firms like PricewaterhouseCoopers, Ernst & Young, KPMG, large, medium-sized, and small size that provide all kinds of financial and accounting services to the general public, to any paying customers, including the big public companies. One of the key services they provide is audit services, but they also provide taxes and other services of that sort. And through their audit services, their role is to assure the investors that the financial data that is published by the public company is verifiable and accurate so that the investors can rely on that information. Now, these three organizations all affect how accounting is done for the public companies. Now let's talk about the public companies. First of all, public companies are owned by shareholders, and if you own a share of stock, that indicates you have a share of ownership of that company. Now, large public companies are governed by a board of directors. We refer to this as corporate governance. And the directors make the large strategic decisions that these companies have to make. And some of those board members are employees of the company, such as the CEO, the CFO. Some of them are outsiders that have been hired due to their expertise. And the companies are run day to day and managed by the managers and employees. Now, to give you a little bit more context, I want to mention that the FASB has been working closely with the International Accounting Standards Board through a process called convergence, whereby over the next few years, the accounting rules that pertain to American-owned companies will be converging or coming together with international accounting rules, so that soon we will have global accounting standards and accounting rules. They are referred to as IFRS, or International Financial Reporting Standards. Now, another bit of background information that's useful to know is that after financial scandals of recent years, the SEC was authorized to set up another organization called the PCAOB, Public Company Accounting Oversight Board, part of the federal government, which oversees the public accounting industry. They watch over the rules of auditing, and also they regulate these public accounting companies and the rules that they operate under. Now we're going to turn to the next topic. Now let's talk about the origin of our accounting system. The kind of system we use now first showed up in Venice in the 1400s. That was a time when the very first multinational trading companies were being set up by people like Marco Polo and his family. And the purpose of the accounting system was to keep detailed records of financial transactions and to report on the financial condition of the company. Remember, accounting is all about information, the kind of information you need to run a company and to be successful. Now, let's think about what kinds of information we need. First of all, we need to know about the assets of our business. Assets are things that have value, specifically future value. That would include things like cash, merchandise inventory, land, property, which would be buildings, vehicles, ships, that sort of thing. And we also would need to know about the liabilities of the company. How much money do they owe to other parties? That would include things like trade payables. In other words, if you're dealing with merchandise and your suppliers have shipped goods to you, but you haven't paid for them yet, the money that you owe those suppliers, or bank loans, or money that you've borrowed from other investors. So if we know about the assets of the business and we know about the liabilities, that gives us a very good picture of the financial position of the company. Now, let's take a more concrete example. Let's say our company has assets, as you see here, cash, 5,000, merchandise inventory, 5,000, land 20,000, property 20, total assets of 50,000. And let's say we have payables of 10,000, bank loans of 20, we have total liabilities of 30,000. Now, if you combine this information together and you want to know what's the combined value of that company, we refer to this as net worth. The word net means to combine together. We would see that the net worth of this company is 20,000, and we refer to that as equity. The equity of the company, and equity is defined as the assets minus the liabilities. And what these very smart Venetian traders figured out is if you take the assets on the left side of an equation and the liabilities on the right, and then if you take the equity and you add it on the right side, you will get a two-column format, assets on the left, liabilities and equity on the right. They will always be in balance. Take a look. Total assets 50,000, total liabilities and equity 50,000. You have a balance sheet, which becomes a very useful statement to show the financial position or condition of a company. Now let's look a little bit more at the word equity and what it means. It means the value of your ownership of the business. We use this term in connection with home equity. See, this is a very lame picture of a house. Let's say you have a house and its market value is $500,000, and you have a mortgage, and so you owe the bankers $450,000. That says that your home equity is $50,000. In other words, the value of your ownership portion of that asset is $50,000. So remember, equity means the value of your ownership of the overall entity. Now, let's go on to the accounting equation. If you look at this balance sheet where we have the assets on the left, and on the right we have liabilities and equity, and we know that the left side and the right side will always be in balance, total assets, total liabilities. We can convert that to an algebraic equation. Very simple. Assets equals liability plus equity. And that is the foundation upon which all the remaining rules and procedures of accounting are based. In just a minute, we're going to look at some examples. Okay, now watch carefully. We're going to take this pretty quick. We're going to go through sample transactions. Now here you see the accounting equation. Assets equals liability plus equity. Number one, starting a business, the owner contributes $50,000. The owner takes $50,000 of his personal money and deposits in the company account, and the company issues stock to the owner. Now, from the company point of view, the company now has received an asset of $50,000 of cash. The company has no liabilities. It doesn't owe that money to the shareholder. The shareholder has contributed or invested that money. But the company now has $50,000 of equity. Where did that equity come from? Well, you see equity is defined as assets minus liability. Number two, the company borrowed $50,000 from the bank. Now remember, the company borrowed the money, not the owner. So from the company's point of view, now has an additional asset of $50,000 and now has a liability of $50,000. Notice no equity took place in that transaction. Assets equals liability plus equity. Number three, the company provided services to one of customers and collected $24,000 of cash from that customer. So the company now has received an additional asset, an additional $24,000 of cash. That didn't affect the liabilities in any way, so therefore, because of the equation, the company now has an additional $24,000 of equity, and we refer to that as revenue. That's the money you earn when you provide services or sell goods. Next, the company paid out $10,000 in expenses. Maybe the company had to pay a lawyer or something like that. So from the company point of view, the assets went down by $10,000 because they had to pay out the cash. Didn't affect the liabilities in any way. Therefore, because of the equation, the equity has to go down by $10,000 as well, and we refer to those as expenses. Now, finally, the company paid out $4,000 of dividends to the shareholders. Remember, the shareholders own the company, and therefore they may decide what to do with company assets, and they may decide to take some of the cash of the company and pay it back to the owners personally. That's called dividends. So from the company's point of view, this $4,000 of cash went out of the company. Assets go down by $4,000. Still no effect on liabilities. They still owe the bank $50,000. So therefore, equity goes down by $4,000 as a result of the dividend payment. Let's put it all together and sum it up. At the end of these transactions, the company has assets of 110, liabilities of 50, and equity of 60,000. Now, we can take this information and prepare an income statement. That shows how much profit the company's made, or the earnings of the company, which is simply revenues minus expenses equals the net income. Remember, net means to combine together. So net income is also a way of saying the earnings of the company, or the profits. Now, let's introduce a term called retained earnings. We're going to focus in on these items here, in the green box here. Our revenues minus our expenses is our net income. We earned, you can see from the numbers here, we earned $14,000 of net income. We took $4,000 of that money and paid it back to the shareholders. So that left us with retained earnings, you can see here, of $10,000. That's how much earnings we retained in the company. We earned $14,000, paid $4,000 back, we retained $10,000. Now, next, we can make a statement of retained earnings. We started at the beginning when we set up the company with 0 retained earnings. We earned $14,000, we paid $4,000 back, and we retained $10,000. Now let's put it all together for the grand finale. That's the balance sheet. And the balance sheet would look like this. Assets, remember, we wound up the period of time with $110,000 of cash. Liabilities, we owed the bank $50,000. Now the equity, we're going to break it down into 2 types of equity. Stock, that was contributed capital, capital that the investors contributed to the company. And retained earnings, that's equity that was earned by the company and retained in the company. And you can see how everything balances nice and neat, just like magic. Hope that's been useful. Now, we're going to wind up each one of these lectures with a very inspirational statement from my dog, Hope. So watch carefully.